Good morning. Thank you for joining us for this taxes webinar. Our presenter this morning is Chris Bird with Chris Bird Seminars. Chris is going to tell you what you need to know to get ready for your taxes. He'll focus on the impact of the Tax Cuts and Jobs Act of 2017 on homeowners, rental property owners, and realtors, as well as the changes to itemized deductions on from 1040 and depreciation deductions for property owners, as well as the new 20% deduction for qualified business income. Chris will be at the Caesars Palace on February 1st and 2nd, speaking for the Residential Real Estate Council in Las Vegas. Chris speaks nationally on the road 160 days per year. This webinar is part of the 2019 Maryland Realtors Webinar Thursday series and one of the free Maryland Realtors benefits. You can view the entire schedule on our website at marylandrealtor.org. Please hold your questions until the end of the presentation, and we will answer as many as possible. Thank you, and let's begin.
Well, welcome everyone. This is Chris Bird speaking, and Jessica, thank you very much for the introduction. And everyone, let's talk about this webinar and what we're going to be doing. I'm going to break this down into basically three categories. First of all, I'm going to be speaking about what you can expect on your own returns with respect to your itemized deductions and what clients can expect as well. Then I'm going to talk about what rental property and real estate property owners and investors can expect. And then I'm going to jump into the real meat of this, and that is what realtors can expect on their business side of their return with this new 20% qualified business income deduction, which is literally the hottest thing in taxes right now. So let's begin. This is all about tax strategies, and it's all about the Tax Cut and Jobs Act of 2017. And just let me tell you how timely this information is. First of all, 95% of this Tax Cut and Jobs Act takes effect in 2018, although for certain depreciation deductions, it actually started after September 27th of 17. But we've had so many changes and notices and regulations issued by the IRS, and just in the last 10 days, the IRS issued final regulations on the 20% deduction, as well as what it takes for rental real estate to qualify for the 20%. All of that is covered in my presentation. So here's my background. I'm one of you. I'm a licensed Illinois real estate broker. I'm a CFP. I'm also ex-IRS. I was an IRS agent for 16 years, and I do travel the country talking about these type of things to real estate groups all over the country. So first and foremost, I have good news. Your taxes most likely are going down. I've done over 1,000 befores and afters. I was working on several this morning for different clients, and taxes are going down for 95% of the individuals that I have run calculations on. So first of all, the major provisions impacting everyone. Tax rates have been lowered. So you can see that 10, 12, 22, 24, 32, 35, and 37%. All of those except the 10% rate are lower than they were in previous years. And the final bill keeps, as before, the current law tax benefits of net capital gains and qualified dividends, and those rates are 0 for some people, 15% for most people, and 20% for higher income individuals. And if you sell rental real estate that you have depreciated, the maximum tax rate is 25% under what is called the unrecaptured Section 1250 depreciation. Now just look at this slide for just a minute. The highest tax rates for your working income, your commission income, those of you that have wages from your S corporation, or those of you that are married with a spouse with a job. Well, the ordinary income can go as high as 37%, but the benefit of investing in stocks and mutual funds and investment real estate is that when you sell, if you've held the property for more than 12 months, then you will face these capital gain rates, which are always going to be lower or equal to or lower than your marginal rates, especially if you find yourself in a 32, 35, or 37% marginal rate, then the 15, 20, and even the 25% unrecaptured depreciation rate are all lower than the marginal rates. So basically, invest, invest, invest. Now, the reason I've got this slide up here is just to let you have a warning that Congress wanted to take away some of the benefits of the 250 and the 500,000 exclusion on the sale of your principal residence if you've lived there for 2 out of 5 years. And what Congress wanted to do, they wanted to change the 2 out of 5 years to 5 out of 8 years, and they also wanted to reduce the 250 and the 500 for people with high income. Well, nothing happened thanks to NAR and RPAC, and I'm telling you more than once today, invest in RPAC because they saved a lot of taxes for the real estate industry with their lobbying efforts in the last year. So the first change of significance is the mortgage interest deduction changes. And this is more important for my listeners on this webinar than if I was speaking in other states where property values are not so high. So if you look at the first bullet, the Tax Cut and Jobs Act reduces the limit on deductible mortgage debt from $1 million, which we've had for a better part of 30 years, to $750,000 for new loans taken out after 12/14 of 17. So the current loans of up to $1 million taken out before 12/15 of 17 are grandfathered under the $1 million rule. But let me just put this in a pointed example. Let's say that you have a client that is buying a home in 18 or 19, and they're going to borrow $1.5 million, and that's their first home. So they have no other loans, they don't have a second home, but they're going to borrow $1.5 million. Well, the problem is because the loan's taken out after 12/14 of 17, they can only deduct the interest on $750, or basically 1/2 of their interest expense is now deductible. So again, this is much more of an issue where you are located than in other parts of the country. Now, secondly, if you look at the second bullet, and this has been a long time coming, Congress is tired of people harvesting the equity in their homes and using it to buy personal cars, pay off personal credit cards, pay for college education, etc. So there's no grandfathering of this kind of mortgage interest. So starting 1/1/18, it is simply not deductible regardless of when that mortgage was taken out. So the good thing is that if you or one of your clients borrowed money on your first home to buy a rental property or to buy a business vehicle or a business asset, that's okay. Or if they borrowed money on their principal res to put improvements into the principal res, that's okay too. The interest is still deductible. But one of the tricky things that is not good here, and is simply in the new law, if you have a client or any of you borrowed money on your principal residence to buy a second home, then that mortgage interest on that second home is home equity indebtedness and is no longer deductible starting 1/1/18. And that's not good. So the problem occurs when money is borrowed, the home is used as collateral, and the funds are used for personal purposes. But interest is still deductible on second homes if the second home, if the mortgage is on the second home. Again, if the mortgage is on the second home, so it is still deductible and subject to the $1 million and the $750,000 limits. And again, the $1 million and the $750 have to do with that before or after 12/14 of 17. So let me say one more thing just so there's no confusion. So if you have an old debt on a first and second home, so you've got two mortgages, one on the first home, one on the second home. and both of those do not exceed $1 million combined, then the interest is still deductible. And now if you go and buy a first and second home after 12, 14, or 17, then the limit is going to be $750,000. So there's a problem. Now, one more thing. And again, my listeners on this webinar are going to have clients that are subject to this next issue. Let's say that you have a client with a old loan, so it's still subject to the $1 million, and they owe $900,000 on their principal residence on this loan they took out before 12, 15, or 17. Now assume they go to Maui or Naples, Florida, or Lake Coeur d'Alene, Idaho, and they want to buy a second home and borrow $400,000 or $300,000 or $500,000, whatever. The problem is this: because they already owe before 12, 15 of 17 more than the $750,000 limit that applies after 12, 14 of 17, then none of the interest on that second home will be deductible, and that is catching a lot of people off guard. Now, the next big item is the SALT limitations, and this is not going to help you, and it's not going to help me either. So individuals that live in high tax states, so this is a combination of income taxes, personal property taxes, sales taxes, and let me say it again to make sure I got it all. State income taxes, real estate taxes, personal property taxes, all of those are now subject to a limit of $10,000. So really 4 things are now limited to this $10,000. In my own case, in 2017, I deducted $35,000 of SALT, and let me tell you how that broke down. $15,000 to the state of Illinois, $14,000 in property taxes, and $6,000 on a property tax on a second home in Fort Myers. I am now limited, my wife and I are now limited to $10,000, and this will negatively impact a lot of you on this webinar as well as your clients. And there's really no way around this under the current legislation. Now, if you look at the second bullet, this has no effect on rental real estate or business properties. This is only on Schedule A of your tax return. They call this the SALT limitation, and basically it is for everything in the top bullet now limited to $10,000 for both single and married filers. So if any of you are single living with somebody and both of you make good income and you live in a very expensive home with high property taxes, staying single, 10 plus 10 equals 20. Getting married, 20 becomes 10. Food for thought. I mean, no humor by that. It's just the way it is. So again, the real negative is when you live in high tax states, when you have a combination of relatively high income taxes and property taxes, you get severely curtailed on the SALT limitation. Now, to counter that, Congress has come up with almost double the standard deduction. So if you're single, $12,000 versus $63.50 last year, $18,000 for head of household, which was $93.50 last year, and $24,000 for joint returns, which was $12,700 last year. So this kind of makes up a little bit, but it doesn't go very far for listeners on this webinar, although it does help people in a lot of low income and property tax states. So look at the second bullet. IRS and NAR both estimate that of the current 32 to 33% of taxpayers who itemize their deductions on their tax returns, that's going to drop to about 5 to 8% of filers starting with the 18 tax return year. And NAR is specifically saying that so you're going to have 92 to 95% of taxpayers getting absolutely no benefit tax-wise from owning a principal residence. However, I have to address this point because of where I'm speaking to. Washington, D.C., Maryland is going to have more people that can itemize, again, because of your high property values and the real estate taxes that go with that, and for the most part, higher incomes and the state income taxes that go with that as well. So, the 92 to 95% may be a high number for people listening to this webinar and your clients. Now, what else? For everybody in this country, personal exemptions are simply gone. So you no longer get a deduction for your personal exemption. So if you've got 3 kids and you're married, that's 5 exemptions that you've lost, and your income is going to go up by about $20,000 some odd dollars. If you're empty nesters, married, that's $8,100. If you're single, it's simply $4,150. However, the sky is not falling because of all the other things that are in the air. For example, the lower tax rates, the higher standard deduction, things like that. Even with exemptions gone, most people will still see their taxes go down. Now, to counter, and remember, I'm just talking in this first third of this time, I'm talking about the personal side of your return. So for those of you who have children who are under age 17 on 12/31 of 18, the $1,000 tax credit has jumped to $2,000, so it's doubled. And the income thresholds have gone up considerably from around 55 to 75 for single and 110 to married. And those are the thresholds where you started to lose the credits. They've raised those to $200,000 for singles and $400,000 for married filing joint, meaning simply that so many more of you will be able to claim the child tax credit than before because of the raise of the income threshold. And the bottom of the chart talks about a brand new non-refundable credit of $500 for every person you claim as a dependent on the front page of your return who you do not get the $2,000 credit for. So this is for the kids who are 17 or older. This is for the college student who's under 24 years of age and is full-time and still a dependent. This is for the few of you that still claim a low-income parent as an exemption, which is an unfortunate situation, but it happens. And this is for those of you, and this is from a humor standpoint, who have that 42-year-old kid who just won't leave home, won't work, and stays upstairs on their computer all day. You might get a $500 credit for this kid who has no income and you still claim as a dependent. And I say that almost humorously if it were not sad. A minor issue. Moving expenses are no longer deductible except for active members of the armed forces. So if you have a client who is possibly self-employed, who moved from one state to another coming into your area, they cannot deduct their moving expenses, and I'm sure you'll get an earful about that, but it's simply part of this tax bill. They take something here to give it somewhere else. Now, I'm done with the personal side of your return. Now let's talk about those of you that own either residential rental or commercial real estate or have clients that do. So first of all, you need to know that Congress wanted to take away, they wanted to repeal the 1031 tax-deferred like-kind exchange and for everything. However, because of RPAC and NAR, they fought bitterly for this, and basically the new law retains all provisions of Section 1031 for real property, for real estate. However, what NAR couldn't do anything about, and they really didn't have any argument about it either, is Congress took away the 1031 tax-deferred exchange on everything else other than real estate, such as your vehicles, your SUVs, heavy equipment that you don't have, but truckers do, and well as builders do. So if you trade in your business car or your business SUV, that used to be a 1031 exchange, it was tax deferred. It is now taxable. However, let me say this. because of the new depreciation rules under bonus depreciation, which I'm going to talk about in a minute, and 179, you can offset the tax on the trade-in by what you claim in bonus or 179 on the new vehicle that you bought. So what else do they do? Now this slide talks about commercial real estate only. So the new law eliminates the 39-year depreciable life on qualified improvements on commercial real estate. This slide is only for commercial real estate and changes that 39-year to 15 years, which results in faster write-offs. So this is to interior build-outs of commercial real estate. But here's the problem, and the slide does not address this. Congress wanted to change the life of qualified improvement property, interior build-outs to commercial real estate, to 15 years to make it qualify for first-year write-off under bonus depreciation. But they didn't get it done. So they made a mistake, and this needs a technical correction. But right now, for all of you that are owners of commercial real estate properties, if you do interior build-outs to these buildings, at this point in time, as the date of this webinar, that property is still depreciable over 39 years and is not eligible for bonus depreciation. And when will they change it? We don't know, but we do think they will. So what they do with bonus? So bonus depreciation, this is the one thing that went into effect that I'm going to talk about in actually part of 17. So this was for items purchased for your businesses after 9/27 of 17. I bought, personally, my own example, on December 31st of 2017, December 26th of 2017, I took delivery of a brand new F-150 pickup truck, which cost roughly $40,000. Why? Because of now bonus depreciation is so good, and it saved me $16,000 in taxes on my 17 return. So now bonus is now unlimited in amount. It used to be only 50% of the cost of the asset. Now it's 100% of the cost of the asset. And the second bullet, bonus now applies to both new and used property. This is huge. New and used property. Now, one thing, bonus is not good for buildings themselves. For example, a residential rental building or a commercial building, and those assets are depreciable over 27.5 and 39 years respectively. This is for the things that you would buy like cars, SUVs, office equipment, computers, etc. And remember, this was supposed to be for the commercial property interior build-outs that were supposed to go from 39 to 15 years. But because they didn't get it done, Congress did not get it done, that 39-year property does not qualify for bonus at this time. So look at the last bullet. If I was talking to you in November, December of 17, I would have told you to take advantage of bonus, and I'm sure some of you did after talking to your accountants, because deductions were relatively better in 17 because of the higher tax rates. And that's why I bought that truck last year rather than in 18. However, that's now a dead issue because we're now in 19, so you really can't even do that for 18 if you had not thought about it at this point. Now, here we come with the rest of my session, and this is where we get into your business side of your return. And you really want to pay attention to this. You need to talk to your accountant about this. And let me just give you my own perspective. I was working on this since 4 o'clock this morning on a couple of different clients. And the tax software that we accountants use is still not making the calculation of this deduction because IRS just released final regulations on January 18th, which is hardly a week ago. So the software companies that do the tax software for your CPAs, etc., have just not had the chance to finish the software to make the calculation. So I know I'm doing this right, but I had to basically do some of the calculations by hand to get to the right answer. So here we go. This is a deduction for qualified business income, brand new. You've never seen it before. This is one of the most significant tax issues that has occurred in the past 31 years. And as of a week ago, we now have specific guidance on how this applies to real estate rental properties. So why do they do this? Why did Congress do this? So what they did in the tax law is they lowered regular corporation, those are C corporations like Boeing and 3M and all the big corporations. They lowered their top marginal rate of 35% to a flat tax rate of 21%. And then the small business lobby went to work on Congress and basically said, what about small business? So here's what happened. While this is nicknamed the pass-through deduction, the official title is the qualified business income deduction. And if any of you are making notes, the applicable Internal Revenue Code section is 199A, as in alpha, capital A. So the amount of this deduction is 20% of your profits, 20% of your profits off the top, and will be claimed on the second page of Form 1040, new line 9. The deduction is only a Form 1040 deduction, but the income from your pass-through businesses qualify. So what are pass-through businesses? This is going to be your sole proprietorship filed on Schedule C. This is now going to be part of your Schedule E, profits from your rental property, if you pass the test that I'm going to show you in a little while. This is the profit from your S corporation, not your salary from your S corporation, but your profit from your S corporation, primarily box 1 of your K1. This is going to be for your profit from a partnership that you're involved in or an LLC. So those are the things that this 20% applies to. Now, we've had a lot of transition on this in the last 12 months. And basically, we were worried all the way through August the 7th of 18 that realtors and real estate brokers were not going to be able to take as big a deduction as other businesses because we were concerned that realtors were going to be included in a category called specified service, trade, or business. However, if you look at the bottom of the page, this is no longer applicable to realtors or real estate brokers. So when when IRS issued regulations, when the IRS issued regulations on August the 8th of 18, they specifically made a statement that realtors and real estate brokers are not specified service, trade, or businesses. And I'll tell you what that means in just a minute. However, again, give credit where credit is due. RPAC and NAR testified before Congress on numerous occasions to get realtors and real estate brokers out of the specified service, trade, or business. Invest in RPAC. Now, so the huge change, right? You can see the top bullet, right? And realtors and realtors and real estate brokers and insurance agents and insurance brokers are not a specified service, trade, or business. What does this mean? Bottom bullet. There is no upper income limit. There is no upper income limit on realtors or real estate brokers that would otherwise qualify them or otherwise disqualify them for the deduction. Every one of my listeners qualifies for this deduction. However, it is complex and you must jump through hoops to get to the deduction. So the first point I want to bring out is and this is going to apply to some of you, but not all of you. If your taxable income is at or below 157.5, and what taxable income is your GCI minus all of your deductions for business, then probably minus your standard or itemized deduction, whichever you can take, that will become your taxable income. If that is below at or below 157.5 for all filing statuses except married filing joint, or 315 or less for married filing joint, then you get the full 20% deduction of your profit. No questions asked. You get the 20% deduction. And it's calculated in a very special way. For example, when you do go to your accountant, you'll notice that they reduce your profit by your self-employment tax, 1/2 your self-employment tax, any self-employed health insurance, any contributions to a SEP IRA, things like that. Those are things that just came up in the last week in the final regulations from the IRS. So none of you are going to be able to calculate this yourself, and I honestly don't believe some of the commercial programs that you can buy for 50 or 60 or $100 and do your return online with them, I don't know if they're going to do this very well either. So here's the deal. Some of you have incomes at or below these two numbers on the overhead. So it's going to be a much easier calculation than for those of you who are above the 157.5 or 315. Now remember this, and this is very, very important. Everybody gets this deduction. It's far easier to compute if you're below the 157.5 or 315, at or below. But if you're above those numbers, and I'm sure some of you are based on where you are, you still are going to get the 20%. However, there are limits. And if you look at the second bullet, the limits are the greater of 50% of wages paid or 25% of wages paid plus 2.5% of depreciable assets. And you know, we don't. This is a 4-hour course to accountants, so maybe even an 8-hour course. So in an hour webinar, I cannot do justice to all of you, nor am I even going to try. But I will say this in a nutshell. Let's just make it real simple and say you are single and you're just killing the business and you're making $700,000 profit on a Schedule C sole proprietor, and you have no employees. All right. Well, look at this. Look at this slide, please. Well, you're obviously above the 157.5, right? And you've got no wages paid. You've got no deduction. All right. So my recommendation is the savior to this is you become an S corporation. You have your commissions paid to your S corporations. You take out a reasonable wage from your S corporation, and that's how you buy part of this deduction. And that is what I'm recommending to realtors all over the country. If your real estate commission allows commissions to be paid by your sponsoring broker to your S corporation. And I travel the country, and far, far more states allow that procedure than don't allow it. So this is something you might want to check. However, one more time, you know, if you're making $700,000, whether you're single or married, on a Schedule C in real estate as a sole proprietor, I don't think you're going to get much, if any, of this deduction, and you need to consider forming an S corporation. Talk to your accountant about this. Now, here's what's new in the last week with respect to real estate rentals. And let me set this in motion. First of all, you're thinking about Schedule E of your tax return, so therefore you own rental property, whether it be commercial or whether it be residential rental. But most of my comments are going to be tailored to the residential rental side. Secondly, you're going to be showing a profit, because if you're going to be showing a loss, you cannot take 20% of a loss. You can only take 20% of your rental profit. And just let me give you an example. I was in Louisville, Texas 2 days ago, speaking on this topic to a group of realtors, to a board. And one woman in her 60s, a career realtor, had numerous Schedule E rental properties, and her profit was $100,000. So after all of her deductions on Schedule E, her profit was $100,000. So 20% of 100 is a big number. So she was extremely interested in this. So the issue is IRS Notice 2019-07, dated January the 18th, applicable to 2018 and later years. So basically, you have to establish what is your rental real estate enterprise, and that is either each property by itself or it's all your similar properties. So my wife and I own a lot of rental properties, and we're going to consider all of them as one real estate enterprise. And you'll find out why I'm emphasizing putting multiple properties into one enterprise is important. Third bullet, the individual or your relevant pass-through entity, like a LLC, must hold the interest directly. So either you've got to own the property directly or through your LLC. So it could be individual ownership, LLC, and I assume a grantor trust, but S corporation ownership, C corporation, or irrevocable trust ownership of your rentals will not qualify you for this new safe harbor. So now look at this if you would. Taxpayers must either treat each property as a separate enterprise or treat all similar properties as a single enterprise, and the underlined part is my recommendation. You must be consistent year to year, and you cannot include commercial properties in the same enterprise with your residential rental. So if you have both, you're going to have at a minimum 2 enterprises. Now why? Here we go. The safe harbor, which means the IRS will not come into your safe harbor and torpedo you, is if you want to claim 20% of your profits each year, you must maintain separate books and records, including checking accounts. You must spend, listen to me on this because I'm going to get more specific in the next slide. You must be able to prove that you spend 250 or more hours of rental services defined in a few minutes on your rental enterprise. So by having more than one unit in an enterprise, it's 250 for all of those in that enterprise instead of each one if you had each one in a separate enterprise. Now, you must contain, and I know this is going to be a pain in the you-know-what for some of you, but you've got to maintain contemporaneous records, including time reports, logs, or similar documents detailing hours, descriptions of services, dates, and who performed the service. So right off the bat, I'm going to tell you this. If you've got 1 or 2 rentals, a single family in a duplex, for example, chances are you're going to have a hard time coming up with the 250 hours. And secondly, your profit's not probably that great, so the 20% of your profit is not something that motivates you. And third, the record keeping, I think, is going to probably derail you from wanting to worry about this. But if you've got a lot of rentals with a lot of profit, is exactly the opposite. Now, look at the third bullet. Because this regulation came out on 1/18 of 19, all the record-keeping requirements are not required for 18, but will be required starting 1/1 of 19. Now, watch this. This is the biggest part of this. So I'm going to tell you, first of all, what can you count in the 250 hours? But first of all, go to the second bullet and look who you can count. You can count all the time by you or your employees or your manager if you have a manager, or any of your independent contractors that you use. So in my case, I'm going to be counting all the lawn mowing hours, all the painting hours, all the electrician hours, all the repair hours of all my independent contractors who are going to be billing me for their time and dollars. So that's huge. So in counting the 250, it's not just you, It's all the people that work on the property. So what services do count? Look at the top bullet. All the time you spend on advertising, negotiating and or executing leases, running credit checks, collection of rents, deposit of the rents, daily operation, maintenance and repair, management, purchase of materials, and supervision of the employees and independent contractors counts. What does not count in the 250, you cannot count this time. Any financial or investment management activities such as arranging financing, procuring property, so buying property, my wife and I are building one right now, and we can't count our time. Studying and reviewing monthly financials, we cannot count. Or planning, managing, constructing long-term capital improvements, we cannot count. And you can't count your hours spent traveling to and from the real estate. So if any of you have out-of-town property and you've got a 4-hour drive to get there, the 8 hours round trip is not part of the 250 hours. Now, a couple of specifics. You cannot use this safe harbor on any property that you also use personally as a residence. So second homes, vacation homes, and bed and breakfast, if you occupy part of that B&B, I think you're going to have a problem. And most accountants are happy about this rule because it can be a can of worms, everybody, in terms of using it 3 months, renting it 9 months, etc. Well, now we just can't count that property at all. Likewise, for those of you that own commercial real estate, any commercial property rented under a triple net lease, which is typical, is not part of this and cannot be counted. Now, here's something that surprised us, all right? So I'm telling you that NAR really recently posted a very good article about this and how high they were on this new safe harbor for real estate rentals. But the IRS is so serious about this that we have to put a jurat, we have to put a statement on our return, and it reads just like this. Under penalty of perjury, we declare that I have examined the statement, and to the best of our knowledge and belief, the statement contains all the relevant facts, etc., etc., etc. And I see the typo error there, and such facts are true, correct, and complete. So never before have we had to do this with a tax return, at least that I know of, but here we have to. So this is good, but it does come with work. So here are my recommendations. My wife's name is Kay, and she manages our rentals, and here's what we're going to specifically do to make sure that we meet this safe harbor. So she's going to keep a desk log of all time spent each month. She's going to purchase a separate notebook. We've already done it, or the like for this, but keep this separate from all other records. We already have a separate checking account for rental enterprise, and I recommend you do not commingle that with your personal funds. And then look at the third bullet. All employees and independent contractors that work for us must provide, in addition to a $1 charge that's going to charge us, we're going to now require a detail of the time that they spent, and I presume not including their travel time. Now, I would like to recommend this too, and I'm starting to see this on websites all over the place. I recommend personally, heartily recommend, that you issue 1099s to all of the subcontractors who are not corporations if you paid them $600 or more in the calendar year, including 2018, and those 1099s are due by January 31st of 19, both to be received by the workers and the IRS to have mailed their copy as well. Finally, at the end of the year, prepare a summary of rental time. Keep separate to support 20% deduction in case of audit, things like that. All right, now before I go into this next topic, let me stay on this 20% for just a minute. I'm going to go back. Let's get away from real estate. Get away from real estate rentals for just a minute. Let's go back to your business of selling real estate. So, just how big is this? I am personally seeing on many of my clients that they're saving 6, 8, 10, 12, $14,000 in taxes. I worked up a couple this morning for my seminar that I'm doing at Caesar's Palace a week from today, where people were going to save $30,000 and $40,000 in taxes between 17 and 18 because of this new 20% deduction against their profits on their business. And I'm telling you, I've never seen anything like this in my life, and I really want you to make sure that you work with your accountant so you understand how this thing works. And, we're probably going to do another webinar later this year, early next year, after we've got one tax season under our belt where a lot of you can see exactly what it did save you. But just make sure you go to a good accountant who understands the complexities of this wonderful deduction so you don't miss anything and overpay your taxes. Okay, what else? So Congress has changed the 179, and most of you know about this, the first year expensing deduction. They've increased it from $510,000 in 17 to $1 million in 18, which none of you will ever see anything like wanting to take that big of a deduction because realtors are not capital-intensive businesses. However, if you own or clients own commercial real estate properties, 179 is now good for real estate roofs, commercial real estate roofs, HVAC, security and alarm systems, etc. And that's quite a big change. And for the first time in the history of the tax code, at least in my 30-year career, we can now use 179 on our rental real estate properties, for example, appliances, ceiling fans, floor covering, blinds, outside equipment, mowers, snow blowers. I have being delivered today a new Cub Cadet snow blower. Cost me $1,000. That's going to be used for our rentals. And we can now 179 that snow blower. And the trailer to haul it, pickup trucks, etc. Now, for the last several years, we've been able to use what is called a de minimis safe harbor of expenses up to $2,500, individual items, which would have also covered that snowblower. But there's no limit on the 179 other than the $1 million total limit for the year. One final note, and there's lots of articles on the web about this. The 179 is for businesses. So if you've got a number of rental properties, chances are it's a business, for example, under that 20% rule as well. But if you've got one duplex or one single family rental, I both say it doesn't qualify for the 20% deduction and will not qualify for 179 either because it is not really a business when you only have one or two properties. And don't pin me to the wall on that because, the big question is how many do you have to own? And there is no magical answer, but at least the IRS has given us some indication with how many hours you have to spend. Now, if you've listened to your accountant or listened to other speakers or simply read Wall Street Journal, you all know that all year long you've been hearing that entertainment expenses are no longer deductible, and that is true. So look at this. So you take your client to the country club, golfing, boating, the theater, to games, season tickets, skyboxes. You can kiss that all goodbye. However, on October the 2nd of 2018, the IRS issued notice 2018-76, which gave us back our meal deduction for 50% with clients. So entertainment gone, but 50% of meals is still good. Now, let's talk about choice of business entity. And again, this goes hand in hand with other things I've talked about. And I simply want to tell you why I like the S Corporation. And I've been to Maryland before. I've spoken in some of your country clubs, and some of you have seen me out there in years past. And my story is no different today than it was 3 or 4 years ago when I was there. So here's the benefit of an S Corporation. Let's say just in round terms you make $100,000 profit. and I have you take a $50,000 salary. You're supposed to take a reasonable salary. Well, accountants disagree on what's reasonable, but we're just going to call that $50,000 is reasonable, and most would agree with me. So only that amount is hit with Social Security tax, which is 15.3%. 15.3 times 50,000 is $7,650. Now, you can withdraw the remaining corporate cash flow in the form of distributions, and you're going to pay income tax on the whole $100,000, but only the 50,000 salary is subject to self-employment tax. Now, if you don't do it and you stay a sole proprietor or a single member LLC, then you're going to have a $100,000 profit. You're going to pay self-employment tax of $14,130, cold, hard, $14,130. And if you do the S corporation, you're going to pay $7,650. So you're going to save $6,480 a year. So this is the other reason why I love the S corporation, why I've been one since 1991. Now, let's move on to other things, because now a lot of these slides go very quickly, and I guarantee you that I'm going to need more than just till 11 o'clock your time. And clearly you don't have to stay on with me, but I could go as long as to 11:10 to get this done. But if you do stay with me, I'll guarantee it's worth your time. And I'm also going to leave 5 or 10 minutes at the end to try to cover some questions, although we'll never get to all the questions you might have. So 4 things that you've got to do to get ready for your taxes for 18 and 19 as well. So get your records organized, request an organizer from your accountant. Believe me, it will help you get ready for your 18 return. Request an organizer from your accountant. Don't fudge on your income or deductions, people. It's not worth it. I'm an ex-IRS agent, and that's been a long time ago, but if you get audited and they catch you doing it, it can only go bad. Check and double check your work before you go meet with your accountant, and do not wait until the last minute. You will miss things, I guarantee it. Many times I have to send my clients back to double check this or that because we don't want to miss something. And the key is this. Look in the red if you would. You got to hire an excellent tax professional, whether they're a CPA or an enrolled agent. I don't care, just as long as they do other realtors. And if you're looking for a good accountant, talk to the successful realtors in your office and find out who they use. Now, record keeping is a requirement, and you've got to be a good record keeper, and I call it being a dork. You can go to IRS publication, I think it's 538, to look at specifically what record keeping requirements are. But here's the deal. Keep everything, and you meet their rules. I keep everything, and I don't even worry about what the rules are because I know I've got it. But on the use of your vehicle, there are some apps out there that are drop dead gorgeous. Whether it's Mile IQ, which I use personally, and I have no financial interest in it myself other than buying it every year. Whether it's Deductor, which is another good one. Whether it's Quicken Business, as long as they have the GPS and the readout for you when you take a trip to record your business mileage, that is the way to go. It's just far too simple not to use. Now, here are those record-keeping requirements from publication 538, and I'm not going to go through it, but you can see it all there, and all that's good. So now, I have a couple of business expenses as we start to wrap this up. But look at this summary chart, first of all. You'll never find a list of everything you can deduct. You've just got to have a good business common sense that if you're spending money on business, you're trying to make money by doing it, then it should be deductible. So look at the second bullet. Is it helpful to your business, needed, appropriate, customary, usual, or normal? If you can meet any of those adjectives or adverbs, whatever they are, you're good. So it really breaks down into a couple of categories. So the big ones are advertising and promotion. And here's the big deal here. Because entertainment is now zero, you've got to try and work with your accountant and in your own mind, move things over that were maybe entertainment in your mind before. Are they really advertising and promotion of your business? For example, a client appreciation event. And I'll give you a real quick example of one that I helped a realtor in Minnesota last summer work on. This realtor was going to take about 30 clients out in a duck boat, one of those duck boats, those World War II things, and those are amphibious boats. And that's entertainment, everyone, and that's not deductible. But after we talked, what he did is he hired a professional photographer. He had banners made at a local print shop, and basically he posed with everybody as they got on, one by one. Professional photographer took pictures with a big banner behind them, just like you remember you saw on Love Boat 20 years ago, 30 years ago, whatever, right? And the bottom line is he's going to write that off as advertising or promotion of his business as opposed to entertainment. Talk to your accountant about it. That's all I can say, all right? So anyway, there you are with advertising and promotion. Let me give you another example. We have a realtor on our board. In fact, he's a partner of ours that he'll take and he will rent a movie theater all day on a given day. And he will invite his world through that day, and he'll post how many showings of a movie they're going to have and things like that. Between every movie, he gets up there and he tells them how much he appreciates their business. He hands out referral cards, things like that. And I'm sure, I haven't asked him, but I'm sure he's going to continue to deduct that as business promotion as opposed to entertainment. Let me give you one more quick example. A year or so ago, we had our 10th year anniversary of opening our franchise office here in Champaign-Urbana, Illinois. We had an event where we basically invited over 1,000 people to come. And this actually was in 17, but if it had been in 18, we would have deducted this as promotion of the business, not entertainment. Why? To get 100% versus zero. Now, the second biggest item here is vehicles, and really pay attention on this one. All right. So last year in 18, the standard miles rate was 54.5 cents, and in 19, it's 58 cents a mile, an increase of 3.5 cents. So I claim standard mileage rate on one of my vehicles, a Toyota RAV4, but I claim actual cost on the other one, which is my truck. So when you claim actual, you take your license taxes, washes, waxes, repairs, insurance, interest on the loan, oil and lube, fuel, and notice what I've underlined, depreciation. And why I've done this is because of the new tax laws on depreciation, we can take a lot more in write-offs than we could before. And let me give an example. Under the new law for 18 and 19, if you go out and buy a car and you don't take bonus depreciation on it and you use it 100% for business, you can take $10,000 of depreciation the first year. Last year, the $10,000 was $3,160. So if you only claim 90%, it's going to be $9,000, 80%, $8,000. So the second bullet, if you buy a car and use it 100% for business and claim the new bonus depreciation, you can claim $18,000, and that number was $11,160 in 2017. And here's why they did this, or here's what happened. For the last 20 years or so, IRS has had a fixation on luxury cars, that we could only deduct $16,000 of depreciation on a luxury car over the first 5 years. Well, effective 1/1/18, IRS raised that, Congress raised that to $47,120. $47,120, up from 16. How's that for a change in 1 year? Now I continue. There's a much larger deduction if you, and pay attention on this one, if you have a heavy SUV with a gross vehicle weight rating over 6,000 pounds, right? So we had a huge deduction in 17, even a bigger deduction in 18 and 19. And then we used to get even a larger deduction if it's a full-size pickup truck with a bed length of at least 6 feet or larger. So here we go. Real quick review, $10,000 on the car, $18,000 if bonus is claimed. Then we have the large SUV. And notice my third bullet, the deduction is huger. I know there's no such word as huger, but I'm making a point. So first of all, you have to look at the production plate on the driver's side door or door jamb. Look in the upper right-hand corner of this production plate, the GBWR in European pounds versus European kilograms, versus U.S. poundage 69.50. So here we go with a beautiful, beautiful Chevrolet Tahoe, whatever, right? With a $60,000 price tag, 100% business use is $60,000 deduction in 18 if you bought it and took delivery in 18. Now, last year in 17, that 60 would have only been $46,000. And by the way, if you only use this vehicle 90%, the deduction would be $54,000, not $60,000. So what if you bought this used, all right? Used, you still get 60 grand. So obviously this would be something different than that Tahoe if you bought it used. But let's say you bought a used Maserati SUV, right? A couple years old, used. You can still write off the full 60 grand the first year. And last year, if it was used, that limit would have been $32,000. So very quickly, look at this. 60,000 this year, 46,000 last year, 60,000 this year, 32,000 last year. And then the pickup truck is as good as it ever was. It's no different. If you drove this vehicle 100% for business, paid 60 grand for this beautiful pickup truck, you would write off 60 grand. But if you drove it 80% for business, it'd be $48,000. So notice this bullet, if you would. I personally use my own vehicles 88 to 92% for business, although I'm striving for a higher percentage with that new truck I bought. But you claim 100% on a return, you get audited. You're going to have fits to get the IRS to accept that. Simple as that. Now, home office is, in my opinion, one of the better deductions to look at, even though your accountant doesn't like it, all right? And the reason I push the home office is you get a mileage from the minute you leave your house to your office, if you're going to your office. And it really gives you another 5 or 10% business use of your vehicle and increases your deductions. However, here are the tests. And Jessica, I'm going to turn this back over to you after I get done with this, but I'll first tell them what else is in my material that I did not cover that they can look at in my PowerPoint. So for home office, you've got to be able to prove that you use your home office exclusively and on a regular basis. And secondly, you must meet the substantial use test. This requires that you must be able to prove that the home office is where you spend the majority of your time to conduct the management and administrative tasks of running your real estate business. On the other hand, if you do that in your broker's office and that's where you spend the most of your time, then forget the home office deduction. But I really push this with my clients. I think it's something that really is a double whammy. You get business use of your home like I do, that's where I'm calling you from today, and you get higher business expense on your vehicle. So Jessica, with that, I'm going to turn it back over to you. Do we have a number of questions?
Yes, we do. Are you ready?
I am.
Perfect. Okay, so they're kind of sporadic, so I'm going to try to just try to piece them together. Okay, Section 199A 207500 cap effect real estate agents. That's a question.
Okay, so read it again. Read the dollar amount.
I think it's, let's see, Section 199A. I think he might have meant 20,000 let's see, 207,500.
What he meant, okay, I got it. Okay, so here's the deal. Okay, and this is what I tried to explain. Every business person out there that files one of those pass-through entity returns qualifies for the 20% deduction. Every business out there. However, specified service trader businesses get a smaller deduction because if they're a specified service trader business, they are limited to the 2075 and under, and 415,000 and under for a married couple. But realtors are not a specified service trader business. So literally, if you had a realtor making $700,000, and this is what I mentioned in the webinar, and they have wages from an S corporation or something like that, they will get this deduction. But if they are a sole proprietor with no wages and no assets, they will get no deduction. So over the 2075 and over the $415,000 limits, they have to jump through other hoops. Jessica.
Okay. What about realtors that are part of a brokerage that get 1099 and haven't created an LLC or other company entity?
Then they are a sole proprietor, right? And if their income is below the 157.5 or the 315, they'll get the full 20% deduction on their profit. Between 157.5 and 207.5, which is a $50,000 phase-in, if they're unmarried, then they'll get part of the 20%. If they're married and they're between 315 and 415, they'll get part of it. But above the 2075 and above the 415, which are the fully phased-in amounts, they must either be paying wages, like through an S corporation, or have depreciable assets to qualify for the deduction. That's what I call the rabbit hole.
Perfect. Another question we have is, I am a residential realtor. If my total business deductions do not exceed $24K, should I bother itemizing if I file married joint return?
Well, number one, the itemizing is not for their business. They get all their business deductions no matter what. Nothing I talked about limits their business deductions. But what's limited to the 24,000, Jessica, is their itemized deductions on Schedule A, which are three primary deductions. That's going to be your state and local income tax and property taxes, now limited to 10,000. Your mortgage interest deduction, and your charitable contributions. So if the total of those three come up to less than 24,000 if they're married, or less than 12,000 if they're single, they shouldn't even bother about trying to itemize or keep the records because it doesn't do them any good.
Okay. Are real estate appraisers no brokerage activities a specified service or business?
In my opinion, they are not a specified service trader business. There's a specific listing of those 9 or 10 categories of specified service trader business. I have never seen a real estate appraiser in the list.
Okay. If my accountant has never depreciated for a vehicle, can that be used if the vehicle was brought in, say, 2015 or 2017?
Well, here's what I bet is happening, all right? I'll bet they brought that vehicle into the business and they're claiming the standard mileage rate. However, they need to talk to their accountant to make sure that the vehicle is being taken care of business-wise under either the standard mileage rate or under actual expenses, which means, yes, it can be depreciated if they're not claiming the standard mileage rate.
Why do accountants not like to take home office deduction?
That's a great question, Jessica. And here's the deal. Contrary to my belief, a lot of accountants think that it is a red flag for an IRS audit. But everybody, listen to this statistic if you would. In the 16 years I was an IRS agent, I never audited a home office deduction return. And In the 30 years I've been out, I've never had a client audited on the home office deduction, and very few accountants have. So I believe it's more worry than it's real, is my point.
Okay, perfect. If you have over 100K W-2 income, does S Corp save you anything on the self-employed income?
Well, there's more to that question, because you can't be an S corporation for a W-2 job. So what they're not asking us, Jessica, what they've not given enough information is, they're telling us they've got a $100,000 job from another source, but what's their profit from selling real estate? That's the question we need answered.
Got it. Okay. Let's see.
If they want to fire back on us, that's fine. Okay.
Okay. Let's see. I just received W-2 is from another source. Profit is 80K.
Very good. Now we got the full question. And the answer, go ahead.
Oh, no, go ahead.
The answer is yes. I would recommend that they think about incorporating that $80,000 profit business as an S corporation for 2019. My threshold is generally about 80 to 100 GCI, gross commission income. And if they're at 80,000 profit, that tells me they're roughly about 110 to 120,000 of GCI. So the answer is yes, yes, yes.
Perfect. Is there an income that you should be making to an S Corp, like greater than 250K? I think that's the question.
Well, I think I just hit that, Jessica, by telling them that my threshold is about somewhere 80 to 100 or more of GCI. So if they're asking me 250, answer is yes, for sure. But it's much lower than that.
Okay. If I became licensed at the end of 2018 and did not have income, can I still deduct business expenses?
Well, number one, tell them congratulations for becoming a realtor. And the answer is yes. Okay, it's not hard to have a loss the first year. However, what they're not asking is what expenses are they talking about. So as a quick rule, you can't deduct anything about getting your license. So going to class, driving to class, paying parking, taking the courses, you can't deduct any of that. However, once they became licensed and once they hung their license with a sponsoring broker, then all their expenses become deductible, from advertising to dues to mileage, etc. So that's the answer to that.
Perfect. If you depreciate a vehicle, does that work like a rental or home depreciation, in which you have to pay the depreciation back later via depreciation recapture?
Absolutely, yes.
Okay. Let's see. Are sellers I keep having questions, I'm sorry. Are sellers forgiven still on short sales on their homes?
That law expired, and this is very specific. That law expired on 12/31 of 17 and has not been extended by Congress as of this webinar date. Whether they will extend it, Jessica, we have no idea. However, these people should definitely talk to their accountant, because they still may not have to pay tax on the debt forgiveness that's shown on a 1099-C if they were either insolvent or bankrupt. But the debt forgiveness for the primary mortgage has not been extended yet past 12/31 of 17.
Perfect. Let's see. So we just had another question kind of following up with that. So then, is the benefit of depreciating just to lower one's current tax burden, only to have to pay it back later? Basic question, but your feedback is very helpful.
Oh, it's a great question, because the answer is yes, it is kind of tit for tat here. You know, you take it now and you pay it back later. However, taking it now as depreciation will save you Social Security self-employment tax. And paying it back is not subject to Social Security tax. So you always want to take your depreciation, even though you may have to give some or all of it back later.
Perfect. And we have room
One
for...
more comment too, Jessica. You have no choice. All right? People think they don't have to take depreciation on an item. If it's depreciable, they have to take depreciation because when they sell it, the tax law requires the depreciation recapture whether you took the depreciation or not. So it's very important they depreciate the asset.
Okay. We have time for about 2 more questions, so
Okay.
I have 2 more for you. Would you recommend cash out refinancing rental properties to purchase other properties?
You know, my wife and I own a lot of rental properties, and I've done exactly that many times. If you've got substantial equity in one rental and you want to buy more, go for it. I just don't recommend using equity in your principal res. I've never liked that idea, and I've never done it myself. But to borrow on other rentals to buy more rentals, great, go for it.
Okay, perfect. And one last question we have is, I have real estate income of $24,000 and expenses of $8,000. Can you take 20% of $16,000 if we file
basically
jointly?
Basically, the answer is yes. All right. Now, what we don't know, Jessica, is what other income is on that return. For example, if they have a job or if they have a spouse with income, things like that. But presuming that they're below the 157.5 or the 315, and it sounds like they are, then basically they're going to get a deduction in the neighborhood of 20% of that $16,000. There's one kicker here though that I've got to mention, and I don't know enough about this question. You know what else is there? But the deduction is 20% of the lesser of your qualified business income or your taxable income, whichever is less. So if that's all the income they've got, their taxable income is going to be a lot lower than their $16,000 profit, and the deduction would be either much lower or eliminated in total. I just don't know enough about what other income they have to fully answer that question.
The only other comment we had from this person is we filed jointly and under 315.
Very good. So that tells me, and the answer is yes. It's going to be 20% of the 16,000 or around $3,200.
Perfect. Well, thank you so much for answering all the questions. I'm sorry we weren't able to get to all of the questions, but we really appreciate you speaking with our members and having you here.
My pleasure, Jessica. Everybody go out and make lots of money and get your taxes done. Bye.
Thank you, everyone.